Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about acquisitions. Everyone loves them. Companies love to make them. Lawyers love to do the legal work on them. Corporate advisors love to advise on them, and investors generally like them because they produce growth, and we all like growth. So joining me today is Ben McGarry from Totus and Chris Stott from Wilson Asset Management. Ben, we'll start with you. Acquisitions, we see some good ones, we see some bad ones. We've seen a few in the last week or so. What do you think? Do you think they're generally a pretty good way to use your capital as a company?
Yeah, we don't have any problem with acquisitions as long as they make strategic sense. We look at what is the company buying? Is it complementary to the existing business? Does it add scale? Is it improving the returns profile of the overall business? And if it ticks those boxes and is even better if it's earnings accretive, generally it's worth backing.
So earnings accretive, but everyone likes to dress up an acquisition as earnings accretive. It mightn't be this year, but it will be next year once we take the costs out, synergies and so on. That all implies risk. So how do we work through that?
Well, I think you should be on the lookout for red flags, which is businesses that are expanding outside their core business, or businesses that are growing slowly and are buying things to make it look like they are growing. I think that mitigates the risk somewhat of acquisitions. How are they funding it? What are they? Who are they buying it from? Is also another good thing to look at. Is it private equity? Why are the sellers selling? Those are good things to consider.
Okay, Chris, you've specialised in the smaller end of the market. And without growth, companies don't go anywhere at the small end of the market. One of the ways they get growth is through acquisitions. They happen all the time. But what have we got to be careful of? Is it what they pay, or is it their track record of acquisitions? Because they're always making them.
I think a few things which Ben also highlighted there. Clearly the multiple they're paying and how that compares to previous acquisitions, I think is really, really important. The accretion these days, given we're in this lower interest rate environment, anemic growth, generally for companies, the accretion that we're seeing listed companies experience from acquisitions is very, very high, and people are desperate and hungry for growth. Mm-hmm. So they're chasing that at the moment. That's working. We've seen that with Mayne Pharma and Vocus more recently. But the key for me is also, and Ben touched on this, is really the motivations of the vendor, the seller. Why are they selling? Was it an exclusively run process? Was it a data room, or and trying to understand, and also are they selling right out of the business? Are they going to stay in the business? Are they going to work in the business? Are they going to have a shareholding in the business post-deal? How are they incentivised to hang around? And to me, the key there is really making sure the individuals or the management team of the acquired business are staying within. Or if they're not, why are they going? And just really exploring that with the company.
And does size matter? So a big acquisition, or at the small end in particular, you get the phenomenon of roll-ups. They keep buying other smaller businesses in their sector to get a bigger part of the sector. Does size matter?
Over time, we think it does. Certainly, if you look through the last decade or so, companies that have made smaller bolt-on, bite-size acquisitions have generally done pretty well. And Slater & Gordon's an interesting one, which no one remembers, but they had a great run of acquisitions for a number of years there, where they acquired a number of smaller businesses, very bite-size, if you call it like that. And then they made that giant leap in the purchase of Quindell, which clearly hasn't worked out for them. So
and destroyed the business.
It has destroyed the business.
It
has, and it's priced to there's hardly any equity value left now. So that was an example of one that were quite good at acquisitions for a period in terms of acquiring smaller businesses, and then to take that bigger leap out of nowhere just clearly worked against them.
Okay, size matters. What about the way we fund an acquisition? So there's a few options. Obviously, go to the shareholders, go to the vendors, give them stock. Or you go and tap on the bank's door and say, what can you lend us the money at, and go and buy it that way. Does that matter to you, Ben, how they fund it?
No, we're pretty agnostic as to how companies fund their growth. Debt funding, as Chris mentioned, at the moment is obviously highly accretive, but there's always equity available for good deals, and we don't like to see companies running particularly lazy balance sheets, although given that asset prices are high, growth is low, we're relatively cautious on markets. So don't mind seeing a bit of cash on the balance sheet, but for the right deals, there's definitely equity available.
And have we had a right deal recently? Just this week, we've had Mayne Pharma, these mid-cap companies making quite big acquisitions compared to their company size. Mayne Pharma, Vocus. Anything you can tell us?
Look, it's hard to argue with the Mayne Pharma deal. It's in their industry. They've bought it off a forced seller effectively for regulatory reasons. That's always a great way to get a good deal. It's a US dollar earner. yeah, it seems like a pretty sensible acquisition. Others, you know, where you see multiples moving up and the size of acquisitions moving up in lockstep, you know, perhaps Vocus might fit into that category. You get concerned that perhaps they're just buying companies for the sake of maintaining a growth rate rather than for an actual strategic business reason for doing it.
Chris, you got one that makes sense recently. We saw another one, RCG, this week, make an acquisition.
RCG for the second big acquisition in the last year or so. They purchased the Hype shoe stores on a 6 times historical multiple now. You know, again, some of the best retailers in the country, in our opinion, have got a good track record of integrating businesses over time. The synergies we think are quite reasonable.
So the acquisition's good at this stage. That's a positive.
Look, we think so, and they've got a history of. With the acquisition last year of the Accent Group, integrating that well and generating shareholder value. So they've got a good, strong track record so far of integrating businesses, and they've now got that part of the footwear or shoe market cornered in Australia.
There you go. Buyer's remorse is not for everyone.